Okay, we're going to walk through a few of the exercises here in the stock compensation and then diluted earnings per share computations. So here we have a company that granted restricted stock units of 20 million shares to their executives, and they'll be subject to forfeiture if they're terminated within 3 years. So basically, they have to work there for 3 years for them to vest. Once they're vested, then the company will distribute the shares. So the market price is $15 per share. And at the date of the grant, they anticipated that 7% of the recipients would leave the firm prior to vesting. On January 1st of 2025, 6% of the restricted stock units are forfeited due to an executive turnover. And they choose to report the forfeitures only when they occur. So that means for that first entry, we're not going to do anything. So if we come down here, we calculate what it is. So our $15 times our 20 million shares, it's $300 million to total compensation. Vesting over 3 years, so we divide it by 3, so that's $100 million. And again, they're going to record the forfeiture as it happens. So in that first year, nobody has resigned. So in year 1, we're going to debit compensation expense for the 100 million, and then we're going to credit paid in capital restricted stock for the 100 million. Then on January 1st, 2025, one of the executives has left, or maybe a couple, whatever. But so it's a result of 6%. 6% of these are forfeited due to that executive turnover. So then now we need to adjust our compensation expense. So we take our 3 million minus the 6%, and then we're going to multiply that by the 2 years, because now we're at the end of 2025, and then we're going to divide it by 3. So 3 million minus the 6%, or sorry, 300 minus the 6%, my calculator's not doing that math for me correctly. But so again, this shows you it worked out. For some reason, I'm struggling to back into it with my calculator. But so we subtract out that 3 million that was forfeited. So the 6% of the 3 million is subtracted out. And then we're going to multiply that by our 2 years that because again, we're at the end of year 2, and then divide it by 3. So that would be for what was just for this 1 year. And then that would be for the full 2 years. Then we'll subtract out what we did last year, which gets us to the 1 year's transactions. So again, the 6% times the 300 gives us 18 million. So we subtract 18 million from 300, and that gives us 282 million. Times 2 divided by 3 gives us 188 million. Now my calculator's working. And then we subtract out the 100 million that we took last year. And then that 88 million is what we're going to charge off to compensation expense and put into paid in capital for year 2. Now then year 3, we are just at the 3 million minus the 6%. So again, that's 18 million. So that leaves the 282 million. And then we're going to subtract out the 100 million that we took in year 1, and then the 88 million that we took in year 2. And then that would leave us expensing 94 million in year 3. So that is how those journal entries are created. Okay. All right, then we're going to move on to stock options. So we have this company has provided share-based compensation to its employees. So under this executive stock option plan, they have granted options on January 1st of 2024 for executives to acquire 11 million of the company's common shares over the next 5 years. So again, we've got 5 years. The market price on the date of the grant is $52. They ran it through that fair price or that option pricing model, and they came up with $12 per option. No forfeitures are expected. So then we're going to take the, if we go down here, we're going to take the $12 fair value times the 11 million shares that we are offering, and that's 132 million, and it vests over 2 years. So we issue them on January 1st of 2024. They're fully vested on December 31st of 2025. So for 2024 and 2025, we're going to charge off 66 million to compensation expense. So the total compensation cost is 132 million. Then when we initially issue them, there's no entry because again, we're issuing them normally at the market price on that day. But at the end of each year to vest, we're going to debit compensation expense and then credit our paid in capital stock options. Okay, then that one's a pretty easy one. Okay, then now we're going to exercise some stock options. So we've got, again, same scenario. They are issuing an incentive stock option plan to its managers. 4 million shares are granted. The exercise price on the market date is $5 per share. The options cannot be exercised until January 1st of 2026. So that is 2 years later. And then they have 4 years to exercise them. They'll expire on December 31st of 2023. They run it into their option pricing model and it's $1 per option. So determine our compensation cost related to that package. So now we go, because again, there's a price involved, they are going to pay $5 per share exercise price. And then we're estimating that the options are worth $1. So that dollar is what we use to figure out our compensation expense. Again, it's vesting over 2 years. So take the 4 million divided by 2. That's going to be 2 million a year. So our first answer is the 4 million. Then our second answer is going to be 2 million each of those years. Okay, then we get into the third thing where it says, now prepare the appropriate journal entry to record the exercise of 75% of the options on March 12th of 2026 when the market price is $6 per share. Okay, so they've got, again, 4 million shares. Let's go down here and see if they map that out for us. So they have 4 million shares, and they're saying that 75% of those, so that times 0.75, gives us the 3 million. So 3 million shares are exercised. The employees or the managers have to pay $5 a share. So that is our $15 million in cash. We put in $1 for each, going back to that first entry, we put in $1 for each option, and that was what got credited into our paid in capital stock options. So we have to take it out, the 3 million out of our paid in capital stock options. Then we're going to credit our common stock at the dollar par because we're issuing out those shares now to the actual employees in their name, and then the excess goes into paid in capital. Then the fourth thing says now on December 31st of 2023, the remaining options that vested expired without being exercised. So then again, look at what's in our paid in capital stock options. We had 4 million, 3 million of those were exercised, so that leaves 1 million. So we're going to take it out of that paid in capital stock options by debiting it and then credit our paid in capital expiration of stock options. Okay, then our last one, we have a diluted earnings per share. Now, again, look back through the PowerPoint because you could have a variety of different things. Always remember, our basic earnings per share is going to be our net income that is distributable to the common stockholders. So that's our net income less our preferred dividends divided by our weighted average shares outstanding. Now, the diluted one is going to get into a little more math because it's going to say, okay, if we end up converting those preferred stocks, we no longer have to deduct the dividends, but now we're going to have more shares outstanding. So then this one we have, again, their common stock outstanding at $1 par is 1,160,000. They have non-convertible preferred stock at $50 par, $20,000 worth. They issued a 25% stock dividend on the common stock, and they pay out $95,000 cash dividends on the preferred stock. So if we're calculating out our earnings per share, we've got our numerator, which is going to be the net income for the year, the $5,600,000, less our cash dividends of $95,000. So that leaves us $5,505,000. And then our denominator is our 1,160,000 shares. Now, in this case, the preferred stock is not convertible, so we don't have to adjust for that, but we have to adjust for this 25% stock dividend. So then the 1,160,000 shares is going to increase by 25%. So if we multiply that by 1.25, that gives us a denominator of 1,450,000 shares, and that calculates out our earnings per share. So again, that one's a little bit easier. They'll all be a little different, so just kind of read it and pay attention to the words. If they're convertible, then you, like with this one, if it was convertible preferred stock, you'd have to adjust the numerator and the denominator as if the preferred stock was converted. We would not be paying the dividends, and then we would have more shares outstanding. And then if it was bonds, you'd have to adjust the net income because you're not paying interest, and then you'd have more shares outstanding.